this was on Nvda, which has been a really big, huge mover. So here's one. This was back in May. So this was the earnings were going to be released after the close on the 24th of May, and it was trading at 305.38. And then the expiration was the next day. It was 2 days later. And so it went from 305.38, and you see into expiration now is up at 389. So it's up 27.66. So this is why it's really important. You may, if you've done, these types of earnings trades, it may, I've seen a lot of traders, all they want to do is sell volatility. And I've seen them just get crushed because look at this. So if you sold this huge volatility, had a big volatility spike up, but look what happened. It had this spike up 27%. So you just got crushed if you were just selling volatility and you didn't realize, the potential consequences of doing that. So you can see here is where it was closing right down here. Now the trade, this was set up as a Iron Condor debit spread, and here was all it had to do was close above this price point here to the upside or down here. And this one closed. Not only did it close, but it closed up almost 28%. So let's take a look at the setup. So here was the structure of the trade. So this again was the Iron Condor debit spread. So it was set up for an expected move on this going into the earnings was 7.16 expected move up or down. So set the trade up. All it had to do was move up 5% or down 5%. And if it did that, it would make a profit. And the tendency for Nvda is it has big price moves. So this thing, you can see that then on the expiration date, it was up over 27%. So this was again selling. This was buying the call debits through 317.5. So it looks like the structure like this. So your call debit spread here, put debit spread here. Okay, so that was the 117.5, 120, and then here was the 292.5, 290 right there. Okay, so all it had to do was move up 5% or down 5%. Well, it was up 27%. So that one was no problem. Now, some of them you just never know. And the total cost then was $155, your debit cost. And then the difference between that $2.5 wide spread was $95 profit. So here was the trade setup, and it just blew to the upside right here. So this one was a no sweat winner. So up $95 per spread profit on that risk of your spread risk of 155, and that's your return of 61%. So that's kind of the typical thing that you should look for if you want to play a price type spike.